we have Jonathan Garner, Chief Asia EM Equity Strategist at Morgan Stanley, who's joining us on the show. Jonathan, good morning and thanks so much for joining in.
Good morning. Nice to be on your show.
Right, Jonathan, let's get off the bat by talking about the metrics that you think are favoring India at the moment.
Well, I think the first thing to begin with is the very strong domestic growth environment. Nominal GDP growth is running 12 to 15% right now. So just to contextualize that, that's just about the highest in the world. It's 3 times the nominal growth rate of China. And the Indian stock market is full of domestic demand stocks, which can benefit from that underlying buoyant domestic growth environment. So India has far superior earnings per share growth compared to the rest of emerging markets.
Right, Jonathan, but you are not too concerned about valuations at the moment when it comes to India?
So valuations are high on a historic basis, so historic price book of about 4 times and a historic PE of probably mid-20s, depending which index you use. But it's all about that ability to compound earnings per share growth. And the work done by our team in India, led by Ridham Desai, suggests that we're looking at least to 15 to 20% compound EPS growth in rupee terms over the next 3 years or so. So that brings the forward PE multiple down quite considerably. And so, yes, it's true that India is to some extent expensive versus other emerging markets, but it's never had such strong fundamentals relative to emerging markets as it has now.
You are overweight on India. What are the factors that determine your overweight rating as far as nations go?
Well, we look at a lot of different factors. We just spoke about some of them, earnings growth and valuations. We also look at medium-term ROE trends. And again, there, the story in India is positive. It has actually the highest ROE of any major market in the world other than the US. And we look at long-run sovereign risk and policy characteristics. And again, if you look at the current account position of India, the FX reserve situation, the fact that the currency and interest rates are much more stable than in the past, this is all attractive.
Right, Jonathan, can you talk to us about your expectations when it comes to interest rate trajectory, the kind of environment that you're seeing at the moment? The Reserve Bank of India has not indicated anything at all when it comes to, well, bringing rates down. But your view, perhaps some sense that you can give us here?
Well, I don't think it's as important, frankly, not just for India, but for other markets, the interest rate trajectory. Ultimately, stock markets are about corporate earnings and valuations. But we would expect Indian interest rates to broadly track those of the US in the upcoming down cycle in US rates. But that down cycle in US rates will be quite slow, and it will begin in the summer. And any down cycle in Indian rates will be relatively slow and may begin at some point this year. But that's not the reason why we're bullish on Indian equities.
Jonathan, then let's talk about sectors. What sectors do you like at the moment as far as India goes?
So we have overweights on 3 sectors, financials, industrials, and consumer discretionary. So all 3 are in that domestic demand grouping that I referred to earlier. So they're direct plays on the underlying buoyant economic environment. And we're more cautious on classic defensive sectors. Right.
Jonathan, off late, we've seen a little bit of a divergence between state-owned banks in India and well, the private sector space. How are you placed here, and what are the financial themes that you like specifically if you were to cut it up further?
Well, I can name a stock that's in our focus list, ICICI Bank. So we obviously lean on the work of our domestic team and our domestic banks analysts, and that's the name that we currently prefer. Other mega caps that we have in our list include Reliance Industries. We also have recently added exposure to the real estate sector, which is something we've not historically had exposure to in the form of DLF. So again, I wouldn't be the best person to talk to about the nuances of state-owned banks versus private banks in India, but the one that we like is ICICI Bank.
Fair enough. Jonathan, what is it that you like in industrials, and why do you like that as a theme? What do you see in here in terms of what could potentially work for this particular sector?
Well, again, India's very much in this phase of urbanization, industrialization, public and private capex, which helps industrials. So Larsen and Toubro has been a name that we've had in our focus list. And I mentioned also Reliance Industries. And again, this is in sharp contrast to what's going on in another market in our coverage, which is China. So these are the two opposite sides of the story, really, where China's underlying growth engine is not functioning as it did in the past. So the same sectors that we favor broadly in India, we disfavor in China. For example, Chinese financials, real estate, industrials, and consumer. These are all things that are struggling in that other large market in Asia, ex-Japan.
Well, I do want to talk about China in just a bit, but before that, as far as the India consumption story is concerned, at least in the staples hasn't done well. It's not showing up in earnings, but you do have a positive stance as far as discretionary is concerned. Again, yes. Themes that you like here, and why do you think, why you expect this particular sector to do well?
As incomes rise, typically within the consumer budget, people start to spend more on discretionary, and the relative spending on staples, the relative spending tends to decline. So this is something that we saw play out over 2 decades in China. But in India's case, Maruti Suzuki is a name that we include in our focus list. So that's a classic play on this process of households actually being able to increase discretionary spending.
Jonathan, then in that case, I want to shift focus to China. And of course, we've already seen a substantial correction in the indices here. What are the challenges with respect to the economy, one? And second here is that, does that mean that we will continue to see an outflow of funds, foreign funds, from the Chinese markets going in?
Yes, so the issue in China is what we call a 3D problem. So debt, demographics, and deflation. And that's leading to a structural decline in corporate return on equity, which is now far below that of India. And so what you're seeing, again, is investor reappraisal of the long-term growth prospects for the market, and that's driving a multiple derating. So the low forward PE multiple on China, in our opinion, is actually warranted. Indeed, it may move lower because the market as a whole is no longer capable of generating earnings per share growth. To some extent, it's become a value trap.
Right. And yet, do you see any positives as far as China is concerned for investors to stay there?
Well, we're waiting to see if there's any stimulus, particularly targeted at the consumer. We think there needs to be quite a major kind of like anti-deflation package, to put it that way, given where household expectations now are. Households in China are starting to pay down debt for the first time ever, reduce mortgage debt. They're very unwilling to engage in discretionary consumption, whereas of course the opposite is true in India. There's a long road ahead for India in household leveraging up and discretionary consumption spending. So unless some measures are taken in China to re-stimulate the consumer, it's very unlikely the market will turn around on a sustained basis.
Sure, sure. Jonathan, also, you mentioned Japan in your report, and of course, we've seen contraction in GDP come in. That said, today we have seen Japan move up about a benchmark. The last time we saw that benchmark come through at the level of the Nikkei, that at 38,000 was back in 1990. What are the factors that are playing in favor of Japan?
So Japan and India are our two bull markets within the New Era thesis that we have at opposite ends, obviously, of the GDP per capita spectrum. But the Japan market's quite different from the India market. About half of market cap is globally engaged in sectors like technology and capital goods and many others, pharmaceuticals as well, with quite a large exposure to the overall global macro cycle. And those leading sectors in Japan have actually been improving operating margins and net income margins versus global peers. Just on that GDP point, you have to be very careful about that because of the way that the Japanese economy moved through the COVID reopening. The first half last year was very strong, and there was some slowdown in momentum that we think is temporary in the second half. But for the year as a whole last year, Japanese nominal GDP growth was around 6%. Which is a 30-year high, and certainly higher for the first time ever than China. So the biggest story here is that actually domestic growth in Japan is also perfectly fine. So it's no surprise to us that the Japanese market's making further progress, as you're highlighting on your show.
Right, Jonathan, a final question then. When it comes to near-term challenges in India, if any, or potential risks, can you enumerate some of them?
Well, my colleague Ridham has written about a likely pickup in volatility ahead of the elections. That's as far as we can go in our comments on that, clearly. Obviously, if there was a very rapid slowdown in the US economy, that could be negative for markets generally. But again, that's not our base case. On that point, though, I would say that the beta of the Indian market to the S&P and global markets has reduced substantially in recent years, and that's testament to a lot of the things we talked about earlier in this interview, just the strength of the domestic economic story, earnings story, and better sovereign balance sheet position than we've had historically. So things are set very fair for Indian equities to continue to do well, in our view.
Right, Jonathan, we'll leave it at that. Thank you so much for joining us and taking us through your report as well as your observations. Well, that's the Morgan Stanley telling us about the view on India and Japan, and of course India leading the emerging pack, one of the preferences, along with Mexico and Poland, among others.